Dear students, in this video, I'm going to explain one more practical question on the financial management. This video is part 2. I also suggest you to watch part 1 along with the video on trading on equity. Let's have understanding on one more question. Here we have the question. Vedansh Limited has a share capital of rupees 10 lakh divided into shares of rupees 100 each. That is, we have 10,000 shares of rupees 100 each. For the purpose of expansion, the company requires additional funds of rupees 5 lakh. The management is considering the following alternatives for raising the funds. First alternative, the company has to issue 5,000 equity shares of rupees 100 each or to issue 10% debentures of rupees 5 lakh. The company's present earnings before interest and tax is rupees 4 lakh. That is the earning before the expansion of the program. Now what we have to do, assuming that the rate of return on the investment remains the same before expansion as well as after expansion, which alternative should be used by the company in order to maximize the return to the equity shareholders. The tax rate is 50%. Show your working clearly. So now what we have to see, the company has two alternatives to raise rupees 5 lakh, either to raise 5,000 more equity shares or to raise 10% debentures. Now, under which alternative the existing equity shareholders will benefit? For this purpose, we will have to find out earning per share. So, we will see earning per share under first alternative and also earning per share under alternative 2. So the earning per share, wherever it will be increasing, we will go for that alternative. So now we have to understand how the earning per share is calculated. Earning per share is calculated by finding out earning after interest and tax divided by number of equity shares. So we have the earning before interest and tax. We have to convert into after interest and tax. So this earning is before the expansion. We need to find out the earning after expansion. So how we can find out that? We have one parameter to find it out, that the rate of return remains the same. So for this purpose, what we will do, we will see the investment before the expansion. Investment, that is capital invested in the business, was rupees 10 lakh, and against 10 lakh rupees the company's earning was rupees 4 lakh. Here you can understand. So capital investment before the expansion was rupees 10 lakh. Earning before interest and tax was rupees 4 lakh. So rate of investment, rate of return on investment would be 4 lakh, that is in earning before interest, tax and dividend upon capital invested 10 lakh into 100, that is 40%. So we have calculated ROI was 40% and that remains same after the expansion. Now what we have to see, that after the expansion what is the expected earning before interest and tax. So after expansion we need rupees 5 lakh additional funds. Capital employed would be existing equity share capital of rupees 5 lakh plus additional 5 lakh rupees, that is 15 lakh rupees. Earning before interest and tax would be 40% of the capital investment, because earning on the investment is same before the expansion as well as after the expansion, that is ROI remains same. So ROI on the new capital employed, that would be 40% of rupees 15 lakh rupees, 6 lakh rupees. Now we have to see earning per share under both plans or both alternatives. Earning before interest and tax under alternative first is rupees 6 lakh and also rupees 6 lakh under alternate 2. Now under alternative 1, where rupees 5 lakh is being raised through equity share capital, we will have to pay no interest. So interest would be nil. So earning after tax or before, after interest and before tax rupees 6 lakh. Now on this 6 lakh we have to pay income tax 40%, 50%. 50% of rupees 6 lakh, rupees 3 lakh is the tax and earning after tax is rupees 3 lakh. Now we have the earnings or net profit after interest and tax rupees 3 lakh under alternative 1, and under alternative 1 we have raised funds by issuing equity shares, 5,000 equity shares of rupees 100 each. So earlier we had 10,000 equity shares. Additionally, we will issue 5,000 equity shares. So total equity share would be 15,000. So earning per share would be 3 lakh upon 50,000 rupees 20 per share. I hope you must have understood the how earning per share has been calculated under alternative 1. Now we have to see earning per share under alternative. Under alternative, where we had to raise additional fund by issuing debentures. So earning before interest and tax is rupees 6 lakh, again the same. And now in this case, as we have raised rupees 5 lakh by issuing debentures, on the debentures we have to pay interest at the rate of 10%. So 10% of 50 lakh rupees would be 50,000. So earning after interest will be rupees 5 lakh 50,000. On 5 lakh 50,000, we will pay income tax 50%. 50% of 5 lakh 50,000, that is rupees 2 lakh 75,000. Now earning after interest and tax rupees 2 lakh 75,000. So this is net profit after interest and tax. It will be divided by the number of equity shares. So in the second alternative, where we have raised the funds through debentures, equity share capital will remain same as usual, that is 10,000 equity shares of rupees 100 each. So here 2,75,000 will be divided by 10,000. So now this way earning per share in alternate 2 is rupees 27 rupees 50 paisa. So this way we can understand that where the additional funds were raised by issuing equity shares, earning per share was rupees 20, and where the funds have been raised by issuing debenture, earning per share is rupees 27.50. This way we can see that alternate 2 is the best option to raise additional funds. Now one more thing what we can understand, why earning per share in case alter 2 has risen. The reason is ROI is 40% and rate of interest is 10%. So wherever the ROI is more than the rate of interest, equity shareholder will always tend to gain and their earning per share will always rise. So one more thing you can note, where the ROI is less than rate of interest, then the shareholder will not be gaining, they will be at loss. So this way I hope you must have understood both the cases and the entire question. Thank you so much for watching the video.